that. Willem Buiter is ready. Let's connect with him. Let's say hello and good morning to Willem. Willem, good morning. Thank you for joining us. Is the comeback trade in the Chinese market and the assumption that Chinese economy is in for a strong recovery, do you think there is merit in discussing that, or that is something which is overdone, over-discussed and should be ignored?
Well, everything is possible, but not everything is likely. I think it's very unlikely that you'll see vigorous Chinese growth in the year going forward. The official target of near 5% is unlikely to be met if you look at the true data. Undoubtedly, the official data will come up with something close to 5%. To get stronger demand, material fiscal stimulus is required, and nothing has been announced as regards that. Even the monetary easing that has taken place has been, I think, too little, because inflation is still well below target. So China, I think, will not be an engine of the global economy in the year to come.
Historically, we've seen that when Fed has cut rates, dollar goes down. I'm talking the dollar index. It leads to flows back into emerging markets. Do you think the same playbook could be at play again?
Well, the Fed has cut by 50 basis points at its last meeting, but rates are still elevated, right? And so I do not think that the Fed is likely to have many more cuts in the month or even the year to come. So I don't think there's going to be any material weakening of the US dollar, especially since domestic demand, consumer-driven, also partly investment-driven, continues to be remarkably strong.
Point taken. Hi, William. This is Anisha joining in the conversation. Just wanted to get a better sense from you as to where do you think the US 10-year and gold and the other asset classes are likely to settle as well, because we have seen that the bond markets has been fairly active as well. It had breached the mark of 4. It's now around that level as well. And gold too, after seeing that massive rally, is consolidating a bit. Any thoughts there?
Well, I view the 10-year rate, say, in the US, as not staying significantly below 4% going forward. The new normal for US interest rates will not be the near zero policy rates and the very low 2%, etc., 2-year and 10-year rates that we've seen. I think the neutral Fed interest rate is likely to be not very different from 4%. And so I expect that the 10-year rate too will not get significantly below 10% unless there is an unexpected weakening of the US economy and the Fed decides to become more expansionary, which I think is unlikely. Gold, yes. When everything turns bad, gold turns good. I do not think that the fundamental drivers of gold demand and indeed supply have changed very much. What we're seeing is short-term speculative movements causing gold to jump up and down alongside Bitcoin. I don't think it is a economically significant commodity any longer.
Your time, William. Thank you so much for joining in and giving us your take on all that's going on across the globe.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.